Okay, quick question. If I told you your employer is legally allowed to hand you free money every single paycheck, and most people leave it sitting on the table, would you believe me? Yeah, it's true. It's called a 401k match, and it might be the closest thing to a guaranteed win in your entire financial life. But here's the part nobody explains right. Is it better to pay taxes now or later? What happens to that free employer money if you quit next year? Today we're breaking down exactly how a 401k works, pre-tax versus Roth, employer match mechanics, and the vesting schedule trap that can cost you thousands. Alright, let's start simple. Forget taxes, forget Wall Street. A 401k is basically just a magic jar your job lets you keep money in for later. You put a little of every paycheck into this jar before you even see the money, and it just sits there and grows over the years. Here's the cool part. Your boss can put money into that same jar too, for free, because the government basically bribes companies to do it. It's called a match, and it's honestly the best deal in personal finance, and almost nobody treats it that way. We'll dig into that in a minute. But first, there are two different jars you can choose from, and picking the wrong one is one of the most common money mistakes out there. Quick note, this channel exists to take confusing financial stuff and explain it like we're just hanging out talking. If that's your thing, subscribe and drop a like. So imagine taxes like a toll booth. Every dollar you earn passes through it. That toll is income tax. A 401k lets you pick when you pay that toll. Option 1 is pre-tax or traditional. Your money skips the toll booth right now, going straight into the jar before taxes even touch it. That lowers your tax bill today, more money in your pocket right now. But when you're older and pull money out, the toll booth is waiting for you there instead. Option 2 is Roth. You pay the toll up front, out of your paycheck, and it goes into the jar already tax cleared. Here's the wild part. Every dollar that money earns from then on, all the growth, never gets taxed again. Withdrawals in retirement are completely tax-free. So, which is better? Nobody can say for sure. It depends on whether your tax rate will be higher now or later, which nobody truly knows. Rule of thumb, young and not making big money yet, Roth tends to win. Already in a high bracket, pre-tax can save more today. You can even do both. Quick fact, as of 2026, you can put in up to $24,500 a year under 50, plus catch-up amounts if you're 50 or older. These limits adjust yearly. Now let's talk about the match, because this should make you a little mad if you're not using it. Say your employer matches 50% up to 6% of pay. Make $50,000 a year, 6% is $3,000. Put that in, your employer tosses in an extra $1,500, free, just for participating. Don't contribute that $3,000? You don't get the $1,500 either. It evaporates. It was never claimed. Turning down a match is walking past free cash. But that employer money doesn't always belong to you the moment it lands. That's where vesting comes in. And this is the plot twist. Your own contributions are yours forever the second they land. Nobody can claw them back. But your employer's match is a different story entirely. Companies use a vesting schedule, a countdown clock that decides how much of that free match you actually get to keep if you leave. There are two flavors, straight from the IRS rulebook. Cliff vesting, 0% until a certain year, up to 3 years, then boom, 100% at once. Graded vesting, you gradually earn ownership, say 20% year 2, 40% year 3, fully vested by law in up to 6 years. Picture this. Someone works 2.5 years, has a juicy match sitting there, quits for a better job, and walks away with none of it. Not a scam, just a rule they never read. One exception. Safe harbor plans must vest employer money immediately or within 2 years. Know your plan's rules before you quit. So let's zoom out. Pick pre-tax or Roth, based on your tax situation. Contribute enough to get the full match. Watch your vesting schedule if you're job hopping. One more thing. Pull money out before age 59 and a half for most reasons. You're looking at income tax plus a 10% early withdrawal penalty on top. That's the whole engine. Pre-tax versus Roth is just about when you pay taxes. The match is free money with strings called vesting. And that's how a 401k actually works. Start to finish, no jargon required. If this finally clicked, smash that like button. Drop a comment telling me which part surprised you most, especially the vesting schedules. Subscribe for more confusing finance stuff explained like a normal human. Share this with the one friend who just started a new job and has no idea what box to check on their 401k paperwork. See you in the next one.